Assalamu alaikum. A very good day to you. And at first, I would like to provide all types of praise for the Almighty Allah who has given me a chance to join such like a digital platform. And here, I am Mohammad Hossain, lecturer, Department of Accounting, Government Hossain Said Sorordi College, Magura. And today I am going to take a session on stock valuation. I hope so at the end of session the learners will understand all the points very clearly and they will realize in what way we have to calculate. So in this session, today's topic is stock valuation. Valuing stock. And before it, we have to gather the idea about stock exchange at first. Stock exchange is an institution or organization or association that serves as a market for trading financial instruments such as stocks, bonds, and their related results. And for this reason of being, we have to consider the large companies who are usually arrange their stocks to be traded on a stock exchange. And in this case, two particular points we have to mention. Number one, the firms that wish to raise a new capital, and second one, components for buying stocks. In case of firms that wish to raise new capital, may borrow money or bring new partners by selling shares of the common stock. And in case of components of buying stocks, particular 4 points we have to mention in this case. Number one, the price sales. Number two, volume. And number three, dividend yield. And number four, price earning. That means PE ratio. So, valuing a company and its future may describe in this way: the single most important issue in the stock valuation process is what a stock will do in the future. And value of a stock depends upon its future returns from the dividend and capital gains or losses. Side by side, we use historical data to gain the insight into the future directions of a company and its profitability. And number 4 points, and very important points in this case: past results are not a guarantee of future results. So, valuation is a process by which an investor uses risks and returns concept to determine the worth of a security. Valuation models helps determine what's a stock ought to be worth. It expected rate of return equals or exceeds our target yield, the stocks could be a worthwhile investment candidate. If the stake worth equals or exceeds the current market value, the stock could be a worthwhile investment candidate. There is no assurance that the actual outcome will match expected outcome. So in this case, it is time to understand the required rate of return. Required rate of return is the return necessary to compensate investors for the risks involved in an investment, and for this reason of being used as a target return to compare forecasted returns on potential investment candidates. And for this reason of being, we have to follow the respective formula for required rate of return. Required rate of return equal to risk-free rate plus stocks beta into market rate minus risk-free rate within the bracket. So, required rate of return equal to risk-free rate, stocks beta, market returns minus risk-free rate within the bracket. So, required rate of return will be clear if we follow the example. Here, the respective example, or that means a problem in front of you. Say, for example, assume a company has a beta of 1.30 and the risk-free rate is 5.5% and the expected market return is 15%. What is the required rate of return for this investment? That means you are required to calculate the required rate of return for this investment. Required rate of return may equal to, we have already gathered the knowledge about the formula of required rate of return. equal to risk-free rate plus stocks beta into market return minus risk-free rate within the bracket. And in this case, required rate turn equal to 5.5% is risk-free rate plus within the third bracket 1.30 is the stock beta into within first bracket 15% market return minus 5.5% is risk-free rate within the third bracket. So the ultimate figure by using the calculator we will get 17.85%. 17.85%. So in this case the required rate is 17.85%. Now it is time to calculate the common stock valuation. These methods are grouped into two categories. So number one, dividend discount models, and number two, price ratio models. So it is time to understand in details dividend discount models. Dear participants, the dividend discount models. The dividend discount models, in short, DDM, is a method to estimate the value of a share of stock by discounting all expected future dividend payments. The DDM equation in this case will be indicated by VO. VO equal to D1, 1 for first year, 2 for second year, and D for third year. So VO equal to D1 divided 1 plus K plus D2 divided 1 plus K square plus D3 divided 1 plus K cube plus for infinitive dt divided 1 plus kt to the power t plus pt divided 1 plus kt to the power t. In this case, t for terminal time, d for dividend, and p for market price. In the DDM equation, VO equal to the present value of all future dividends. And in this case, DT indicates dividend to be paid T years from now. And K indicates the appropriate risk adjusted discount rate. So the example in this particular case will be very clear for you to understand all things at the same time. I hope so. The dividend discount model. Suppose that a stock will pay 3 annual dividends of taka or dollar 200 per year, and the appropriate risk adjusted discount rate K is 8%. And in this case, terminal price is $1,200. So now it is required for you to calculate the value of stocks today. So value of stocks equal to, the formula will be D1 divided 1 plus K plus D2 divided 1 plus K square plus D3 divided 1 plus K cube, as it is for third years. In this case, the terminal price P3, that means in third year, 1 plus K cube. So it will be at the end of third year. So now the respective digit we will put into the formula. The respective figure will be 200 divided 1 plus 0.08 plus 200 divided 1 plus 0.8 square plus 200 divided 1 plus 0.8 to the power cube plus terminal value 100,200 divided 1 plus 0.08 to the power 3. And if we calculate it by using the calculator, the respective figure will be 1468.08 is the value of stock. Okay, so it is very easy for you to understand. I hope so. Now it is time to understand the dividend discount model by using the constant growth rate model. Assume that the dividends will grow at a constant growth rate, here G. The dividend next period T plus 1 is D2 plus 1 equal to DT into 1 plus G. So in this case, the DDM formula becomes value of stock will be DO into 1 plus G divided K minus G into 1 minus 1 plus G divided 1 plus K whole to the power T into plus PT divided 1 plus K to the power T. That means this is the total respective formula for constant growth rate model, and T means terminal situation. Okay, now the example, and this example will clear about the practical solution. Suppose the current dividend is given $10 and the dividend growth rate is 10%. There will be 20 years dividend and the appropriate discount rate is 8%. Terminal value $200. In this case, what will be the value of stock based on constant growth rate model? We have already seen the respective formula for constant growth rate model. VO, value of stock, equal to DO into 1 plus G divided K minus G into 1 minus 1 plus G divided 1 plus K whole to the power T within third brackets plus PT divided 1 plus K to the power T. Now the respective digit will put into the formula and will get the value of stock. So value of stock equal to 10 into 1.10 divided 0.08 minus 0.8 minus 0.10 1 minus 1.10 divided 1.08. I have accumulated the figure. This is why the respective issue is as like to the whole to the power 20. This means terminal time plus 200 divided 1 plus 0.08 to the power 20 So the respective figure by using the calculation we will get 286.77. So in this case, the value of stock by using the constant growth rate model, the respective figure will be 286.77. Okay. Now it is time to calculate another format, the dividend discount model, the constant perpetual growth model. What will be the constant perpetual growth model? Here there are some assumption, assuming that the dividends will grow forever, at a constant growth rate symbolized by G. In this case, the DDM formula becomes value of stock equal to D1 divided K minus G. D1 divided K minus G. Okay. So think about the electric utility industry. In mid 2003, the dividend paid by the utility company American Electric Power AEP was $1.4, and using DO equal to $1.40, K equal to 6.5% and G equal to, in this case, 1.5%. So now it is time to calculate the estimate value for the AEP. Value of stock equal to, in this case, 1.40 into 1.015 divided 0.065 minus 0.0115 equal to $28.42. So this is very easy for you to understand. Just you have to keep in your mind the respective formula for constant perpetual growth model for the purpose of getting the value of stock. Okay, dear participants and dear learners, the sustainable growth rate is very important in this case. The sustainable growth rates equal to ROE. ROE means return on equity into retention ratio. In this case, retention ratio means 1 minus payout ratio. So ROE into 1 minus payout ratio is the sustainable growth rate. Here, return on equity, ROE, indicates net income or equity, and payout ratio means portion of earnings paid out as dividends. Retention ratio in this case, portion of earnings retained from investment. It will be very clear if I give an example in front of you. Calculating and using the sustainable growth rate. In 2003, AEP had an ROA of 10%, projected earnings per share of $2.20, and a per share dividend of $1.40. What will be the AEP's retention rate and sustainable growth rate? So, payout ratio in this case, 1.40 divided 2.20 equal to 0.636. And so the retention ratio will be 1 minus 0.636 equal to 0.364. That means 36.4%. Therefore, AP's sustainable growth rate equal to 10% into 0.364 equal to 3.64%. Now, it is time to calculate another problem. Calculating and using the sustainable rate. What is the value of AEP stock using perpetual growth model and a discount rate of 6.5%? So in this case, value of stock will be 1.40 into 1.0364 divided 0.065 minus 0.0364 equal to $50.73. Only we have to use the formula and the respective digit we have to put into the formula, and ultimately we will get the expected figure of value of stock. Now, price ratio, in short, PE ratio. Price earning ratio indicates PE ratio, current stock price dividend by annual earnings per share, that means EPS. So, in this case, current EPS here 0.48, 5 years average PE ratio 38.72, and EPS growth rate 5.50%. The expected stock price will be historical PE ratio into projected EPS. So what will be the calculated figure? Calculated figure will be 38.72 into, within the first bracket, 0.48 into 1.055. If we calculate by using the calculator, then the respective figure will be $19.61. So the expected stock price is $19.61. So thank you all for watching this respective slides. I hope at the end of this session you understand all things very clearly. And besides, it is mentionable that you have to work and you have to practice at your home of your textbook, so that you may understand the respective problems that will arise in front of you. And in this case, one instruction for you: practice, practice, and more practice. Then all things will be so easy and understandable and clear. And this slide will help you to realize about the chapters instruction and what you have to do in future. So thank you for taking a patient and staying with Mobile.